let's look at how the market performed. Surprising. Do you think the MPC decision had any impact on how we saw the market performing today? Most analysts say they feel it's Dangote Cement's performance. Do you think it featured at all into the way we saw the market performing today?
The MPC decision, as you notice, happened between today and yesterday and today. That the meeting was for 2 days, and by the time the decision came and was reeled out and the communique was communicated to the public by the central bank governor, the market was about closing. So it has no impact. Maybe for tomorrow we'll begin to see the impact, but for today, no, definitely not. For today, what we're seeing is profit taking. The market has been a bullish run for about 3 weeks and plus days. It's just good that people smile to the bank. So we begin to see, as we expect some big results again, like First Bank that came into the GT Bank as well, banks. The market will pick up again on the rally.
And actually, analysts did mention it was Dangote Cement.
Yeah, Dangote Cement.
We saw Dangote Cement down about 4 naira, and that was why we saw the markets come
and its capitalization is huge.
Right, that's why we saw the market come down today. But looking at other markets, especially our fixed income market, we saw yields going down on the back of speculation over the MPC rate. And now that the MPC rate is out, how do you see these markets performing now?
The fixed income market, to me.
Yes.
Well, the fixed income market, I just think, this fixed income market has been on the downward spin because of, of course, reduced demand from foreign investors, withdrawal of funds by foreign investors, and of course, on the face of inflationary threats in the economy, which the central bank governor mentioned in the communique. But of course, they will anticipate, of course, removing them on hoping that, of course, based on inflationary expectation, the MPC will review the MPR upwards, but the MPR has been held as what it is. So they will. Well, of course, this money lying loose across the globe, from all these expansionary policies of these global banks, will find themselves back again to the economy. So the inflationary threat, from that perspective, hasn't been solved. It's been pushed into the future. The rate was held, so the yields will still be at what they are.
Oh, at what they are. Okay, well, let's talk about the cash reserve ratio. That came as a surprise to a lot of people. He raised it from 8% to around 12%. What are your thoughts on this, and of course, how it's going to affect lending to businesses and in turn the markets going forward?
Yeah, well, I understand the Federal Central Bank being its twin objective of ensuring price stability in consumer prices and in foreign exchange prices. And the same reason the Central Bank has been giving from 2011 from 6.25% in January up to now, even as 12%, trying to fight inflation. Inflation has not come down. Inflation has rather gone up from 12.1 as of January 2011, instead of the hiking rate, to about 12.9 as of June. So, and again, my fear is that, it's like when 20% of fighting the ground has to suffer. The economy has to suffer because the government cannot keep a tab on resources that is covered in the National Reserve has been threatened. So ultimately, trying to solve that by trying to curb demand, maybe from the banks, maybe because they perceive that the bank has so much money, that's why the bond is floating to the foreign exchange market to cause that speculative demand, is wrong. Because the CRR, jacking up the CRR means that you have reduced the loanable fund in the economy. Implication is that we may begin to see the impact on the earnings of companies in subsequent quarters for the second half of 2012. So that expectation that the market has been seeing, the reaction to the quarterly earnings of companies in Q1 2012 that saw the markets did that well, the same reaction we're seeing to Q2 reactions, we may begin to see a very, 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 very withdrawal of investors' interest because of that jack in the CRR. The jack in the CRR, in my opinion, is not needed. You're killing an hand with a sledgehammer. It's not going to reduce speculative demand for the dollars. And well, I just believe I don't think it's the right decision, in my opinion.
You don't think it was the right decision? That's very interesting. But I have to ask about First Bank's results. We saw them come out with a 26% growth in gross earnings. We also saw a 125% rise in profit before tax. I mean, those are great numbers. What are your take on their results?
Well, First Bank result is just fantastic. It's beating analyst expectation. And I was particularly about 2 years ago, I was in an investor relations meeting with the chief risk officer and chief financial officer of First Bank. And then they said that because they were very risk averse, so they would rather keep the money at the standing deposit facility of the central bank rather than lend money to the public because they were scared. But we've seen that they've grown their loan books over time, and you can see that in interest income. Of course, it's grown, and of course they've taken care of expenses. They've been able to hold on to them and reduce it. But most importantly, that result is impacted by maybe activities of Hamcan, which is very strong in the financial in the banking sector, because of the impairment charges, which is loans made, provisions made for loan losses are substantially reduced. And of course, to end the year, we'll continue to see such strong showing in banks' results, but with the ICANN CRR But I think it's like shooting ourselves in the foot all over again.
Yeah. Well, let's talk about its cost-to-income ratio, and we know that's an important part. We saw half one, it was around 69.3%, half two, 58.3%. What's your take on these particular numbers?
Yeah, I think it's just good. It just speaks for itself, because what it means is that the company, whilst it was able to grow its operating income and grow other incomes as well, it was able to reduce its operating expenses. Implication is that, of course, we have enhanced profitability, and you can see that from the earnings per share figure. Earnings per share figure has grown by that huge number that they had in the profit after tax. So obviously, of course, investors in First Bank, with the shareholders and biggest stakeholders, well, hopefully by the end of the year will smile to the bank. Hopefully they will smile to the bank, given any unforeseen circumstances as it is.
Now, going forward, we know we're expecting more results coming out of the banking sector, banks like GTB and other banks. Give us your take on what you feel we're going to see going forward. Are we going to continue to see fantastic results like this, or do you think that things might change slightly as we go on?
Well, I expect that there won't be any fundamental change to the balance sheet of banks. I believe the balance sheet of banks are stronger, essentially from the activities of AMCON, which is Asset Management Corporation of Nigeria, and you can see that in First Bank result when you see that impairment charges it's substantially reduced. I expect the same for GT Bank and for most of the banks for the Q2 earnings. But as I mentioned earlier on, with the CRR jacked to 12% from 8%, the implication is that the loanable funds, which is the reason why we have seen improved results from the bank, because the balance sheets are cleaner, AMCON has taken care of the bad toxic assets from them. They are more confident to create credit, to expand, to engage in the primary business, which is to loan out money to earn interest income and other fees and commissions and other incomes. So with the reduction in the loanable fund by 4% increase in the cash reserve, which is cash available for them to lend out, I think it's going to reduce activities. I think we may begin to see some impact in that MPC decision on the earnings of banks to end the year.
Okay, well, thank you so much, Babajide, for giving us your take. That was Babajide Solanke, an analyst with FSDH.